In your stock portfolio, do you include any index funds? Well, most people who are interested in the stock market have several knowledge about this one. Now, imagine we told you that the market tracking index fund could be contributing to a major stock market bubble. Indeed, this is what renowned investor Michael Burry recently observed on Twitter. Quoting the difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other. But what exactly does he mean? And is it possible that the seemingly harmless market tracking index fund may cause a worldwide stock market collapse? Let's find out here at The Investing Path. But before we go on, make sure to give this video a like and subscribe, and hit the bell button as well to stay updated for more of our content. Besides that, let's jump right into it. If you want to diversify throughout the entire market, you should purchase a market tracking index fund. For example, the world's largest index fund is SPY, an SP 500 index fund. A little investment in SPY will provide you with a small piece of the 500 largest US firms, with the hope that you will get a return roughly equal to that of the market as a whole. Past performance shows that the long-term return on the SP 500 index has been roughly 10% yearly. According to recent research by Bloomberg Intelligence, passive instruments account for over 20% of the typical S&P 500 company shares capital. Approximately 3.3% of the market was occupied by passive constructions in 2003. It is interesting to note that while Michael Burry has lately brought up the passive investing bubble on Twitter, this isn't the first time he's done so. In an email interview with Bloomberg from earlier this year, he discussed this identical point, saying that passive investment has removed price discovery from the equities markets. Security level analysis is only necessary for real price discovery, while simplistic theses and models that attract people into sectors, factors, indices, or ETFs and mutual funds replicating such techniques do not. This means that when passive investing grows in popularity, investors are increasingly likely to hold shares of large firms just because they are included in an index, regardless of whether or not they have any genuine interest in those companies. Investing in these companies is now motivated by factors other than their underlying performance. The question then becomes whether the craze for passive investing has gotten out of hand to the point that a massive movement from index funds and into cash could destabilize the market. The answer, as usual, is quite ambiguous. For example, let's think back on the fundamentals of stock market movement: supply and demand. Since there are more buyers than sellers, the stock price rises when there is a high demand for the stock and low supply. And conversely, the stock price will stay the same if there is a rapid influx of sellers but a shortage of purchasers. Now, every stock has a typical daily trading volume, or the average number of shares traded in a single day. You should know that share prices only fluctuate a little until a sudden and extreme disruption in daily volume. However, if the market collapses and selling are rampant, there may be a sudden influx of book wanting to exit the market. Until other buyers stabilize the situation, the price will be determined by the most desperate player wanting to get out. When Michael Burry says, all theaters are overcrowded, and the only way anyone can get out is by trampling each other, he's referring to situations like this. And even so, there's just so much room through that door. This standard stock market illustration is used to clarify daily trade volume. Suppose you and 99 other people are at a movie theater, and the only way out is to find someone to take your seat. That's fine when the theater isn't on fire, since people will always want to come in and watch a film. 100 people would be trying to escape all at once. This is the fear Michael Burry has about the stock market. According to him, if things keep getting worse, many passive investors would want to bail out and return to cash. But everyone does this in a panic. It would crush stock values, and the fact is, when things go wrong, it usually only affects a small number of enterprises. But what if many passive investors, many of whom you know maintain a diverse portfolio, suddenly pull out? So, we take it that it causes a total system failure. The impact will be the same on all of the index stocks. But there is an additional conflicting consideration. Despite the high volume of transactions involving these passive funds, trading volume in the underlying companies that make up the index is relatively low. In what possible way does that happen? This because the ETF share transactions occur on the secondary market, where only passive investors transact with one another. Thanks so much to Ben Felix, who did a fantastic video on this very subject. In it, he refers to two pieces of evidence that are very compelling. The first is from Vanguard and displays the proportion of ETF trading that occurs on the secondary market or impacts the trading volume of the underlying equities. They determined that the secondary market was used for trade 94% of the time. As a result, 94% of the total volume of ETF trades did not affect the underlying stock holdings that make up the ET. But what happens when there is a sudden, extreme demand for an ETF or selling? In certain instances, trade in the underlying stock occurs because ETF units were created or liquidated. Interestingly, BlackRock's 2017 research shows that even when regular creation and redemption are factored in, they account for only a tiny fraction of total trading. They gave an example involving Apple, which at that time was the most successful business in the world. They mentioned that $65.9 billion worth of Apple stock changed hands in July 2017, which they called a month which saw the huge inflows of ETFs. Although Apple was included in 331 ETFs worldwide, we discovered that at least 95% of the stock's transaction volume in July 2017 was unrelated to ETF movements. Even while exchange-traded funds have amassed a growing market share in recent years, their impact on the trading volumes of the securities they hold has been surprisingly small. However, Burry may have a point after all. He believes the world's end will come from a stock market crash within the next several years. And if you believe that's what's going to happen, then he may have a point, because true panic in the market can lead to unpredictable selling cycles, and a stock market crash is an instance in which this can happen. If stock prices suddenly collapse, investors may sell in a frenzy, driving up the volume of sales and further reducing the value of their holdings. The stock price may then fall precipitously due to a negative feedback loop. So, according to Burry's logic, if a true market panic occurs and market tracking ETFs are sold in a panic, the widespread selling and destruction of ETF units will accelerate the decline in stock prices. Furthermore, he believes that smaller, less traded equities that still make it into many of the significant indices are more at risk of mimicking this effect. In 2019, he made the following statement regarding the Russell 2000 index. For example, the vast majority of companies in the Russell 2000 index are lower volume, lower value traded stocks. During today's trading, we tallied 1,049 stocks that changed hands for less than $5 million. That's more than half of those 456 stocks, where nearly half of it was traded for less than $1 million all day. However, hundreds of billions of dollars are connected to stocks like this through indexation and passive investing. Even though the S&P 500 includes some of the largest companies in the world, more than half of the stocks in the index sold for less than $150 million today. There are more and more people in the theater, yet the exit remains the same. As a result, the situation becomes increasingly dire as investors move into less liquid equity and bond markets around the world. It is an intriguing viewpoint, and it does make you wonder how small-cap firms in huge indices will perform when the next big market crash occurs and many passive investors flee. Although it is customary to celebrate a smaller company's index membership, this case presents an intriguing scenario in which this may not be the case. And that's all we have for you today. Thank you for watching, but before you go, please let us know what you think about Michael Burry's prediction so far. And while you're at it, please give this video a like and subscribe as well, and hit the bell button to stay updated for more of our weekly uploads about personal investment and financing. This is The Investing Path. Thanks again for watching, and we'll see you soon.